Good morning and welcome to the new edition of my live comments. A couple of weeks back, we have been quite amazed at the way the stock markets were fluctuating and the so-called hyper-efficient financial markets that seem to be so brilliant at fixing the prices of value of everything were in fact bouncing around like tennis balls on an overheated court. And I received a shipload of calls asking me to explain why the stock markets were behaving in this fashion. Pay no attention to this volatility the financial business assured us. It was a technical correction, a bit of the froth taken off the top market that had gotten ahead by itself. Now, what does it mean that by climbing the improbable heights, month after month, week after week, we have been asked to look at the fundamentals? Why the market should be in a free fall, in momentary fits of irrationality? The truth is, the reality is that when my friends asked me to explain, I asked them a simple question. And the simple question was, do you think that the trading on the market is done by the real life human beings? They said yes. I was amazed. In real sense of term, the market is quite divorced from reality. And it's as irrational and as divorced from fundamentals as the way up or way down. You should remember that in reality, a very small percentage is very small fraction of the trading of the stock market is done these days by real human beings. Whether it's New York or Shanghai, whether it's London or Frankfurt, only 10% of trading is done by the real life human beings. Only 10%. So in fact, this hijacking of the stock market was by one robot battling the other robot. Are you amazed? You should not be. We have been talking about how the artificial intelligence is coming up. And that is coming up in a big way as seen in these vagaries at the stock exchange. So as I was saying, that to hardly 10%, and that is the maximum, is done by the real life. Another 40% reflects decisions to invest in the entire stock market or an entire industry or an entire class of companies, index funding, exchange trade funding, and other kinds of passive investment. And that should not reflect. That leaves that the entire market, remaining market, is automatically controlled by the computers according to the complex algorithms that focus on the changes in the market price or price indices caused by the trading done by the other computer. Computer says buy, some would immediately say buy or sell depending on the algorithm created for those typical ones. So, what happens? It's a kind of a robot versus robot trading with a circular logic. And since it's a circular logic, cyclical in nature, either it will keep on leapfrogging or come to an halt and start the downward spiral. Or the possibility can be, it can leapfrog the one day and it can fall down the next day. Fundamentals are not relevant here. What you learned in your class of economics is no longer valid. And that's why people are nonplussed. Secondly, the volumes of the trading are so enormous, and holding periods are often in a matter of seconds. So if you have got millions of stocks to be traded in seconds and sometimes in nanoseconds, and their board's complexity would make them partake of the responses to the other reports much more quickly, but not impulsively, than would be taken by the human being. At the same time, 10% of the trading being done by the human beings with their capabilities which are focused either on one industry or on a group of industries creates a certain vibration for the software. When I say vibration, it's a response time, the pulses that are being generated. And more often than not, trade or a combination of trade, buying a stock, shorting the ETF while selling other options, is a derivative instrument. And don't forget, all this playing around is being done not with the personal money, but with the borrowed money. So nobody's, as far as the trading is concerned, nobody's personal wealth is at stake. And when the enlightened self-interest is not there, the result would be what we saw globally in the last 2 weeks. Trump was taking the credit for the economy going up, and Dow Jones and others went through the sky. And then one computer went in for shortening, other went in for ETF. The responses were immediate, and that was the reason why the fall in one day, Monday last, was 1,000 points, which has not been ever been before. So the point is, why is it that we have done that? It is simply because the volumes have changed. And then, another thing is, the shortened ETF is tied to a volatile index, which for the sponsors of ETF, Credit Suisse, to buy some huge amounts of future contracts. You see, the instrument normally known as VIX in short-term exchange, traded note, or XIV, is apparently has created a vicious cycle, which is selling gets more selling and buying gets more buying. And the result in these 2 weeks was that $3 billion were lost for the investors. But then don't forget it. In a month prior to that, they had gained $6 billion. So the loss was practically $3 billion, and the net profit was $3 billion. Now, who suffered? It is a small-time investor who did not invest with the borrowed money, but invested with his own money. The person suffered. And the volatility and the control by the reports has compelled Credit Suisse to take an action. They say that they will no longer use Velocity Share Index, VIX. This is a good thing to do. And the creator of this is an Indian, Devesh Shah. I happened to have a talk with him, and he said when he invented this instrument in his wildest imagination, he could not believe that this would happen. But if somebody wants to gamble, the instrument is there, and the gambling was successful for some people and others suffered. Now, another point is, for the volatility, which aids the reports fighting the other reports. And that is the rationale put by the forward by the complex instruments and trading strategies that reduce price volatility are the moments of the market gain. Now, when the gain is there, there's a positive impulse, and the software or the algorithms created respond in a manner that has been shared by the computers but may not be to the other computers. So algorithms is different for each computer. It is according to the industry, according to the region, and according to the entrepreneurs. So instead of hedging the risks, which is very often the reason why people buy this instrument, they wind up increasing the risk. Now this is a paradox. The instrument was created to ensure that the risks are hedged, but it doesn't do so. It rather increases the risk, and when it increases for those few people, it has a domino effect, and others who are also not involved suffer as well. So whom do you blame? Do you blame the instrument, or the instrument creator, or the users? And this is particularly the case when the amount is done with the borrowed money. Since it's not your money, you can play ducks and tricks with that. Thanks to the low interest policies of the major central banks that allow hedge funds borrow $5 for each $1 they put of their own. So they have their own dollar, only $1 at stake. If it's a stake of $6, 5 are from the central banks. And the investors trying to cover the short positions or sell underwater options before they expire run into similar dynamics. You see, this happens with every such situation. Way back in 1960s, the father of the modern economics, who has since been replaced, John Maynard Keynes, called the markets animal spirits. And these animal spirits encourage investors to take risks. And along with that, another feature has come into it, that there's a Bitcoin. Imagine the Bitcoin prices ranging from 19,500 to 7,500. They do not have any rational connection to the stock prices. But investors and the markets are not rational. So first we start with the presumption and an accepted fact that the markets are not rational. We say human beings should be rational, but markets are not. The animal spirits, the gambling spirits are never rational. Now on one side you have 90% of the market controlled by perfectly rational algorithms arranged symmetrically, prompting the reports to take action in a set situation. But the parameters of that situation change so swiftly and so unreasonably that the algorithms can go haywire. And once the algorithms go haywire, the result would be either shooting up or shooting down of the market. And there's no reason that the financial system has to be that complex and that volatile. There's no reason for that, but it is there. There's no reason to divert so much of money, talent, and capital, but it's there. And it's there to siphon off funds for the traders and the hedge fund managers. There's a cost to every innovation. And instruments like XIV and the financial innovation, short-term traded notes, do have an impact because they are fed in the algorithms, and the algorithm created at that situation. But that situation changes. and the responses to those changes may not be commensurate with what we presume to be rational. So on the one side is human capability, which at times can be gamblistic and animalistic. On the other side is perfectly rational algorithms and robots. And the interplay is interesting. And that interplay results in the stock market climbing up like crazy or falling down like it has never happened before. This is at times a nightmare, but sitting at a distance I can see how volatile markets are being manipulated by the gambling spirit and aided and abetted by robot versus robot. And this robot versus robot trading has hijacked the otherwise staid, coldly calculating stock market. So as we move further, be prepared for such coaster rollers. They are not in your control. Human capability no longer controls the stock market. It is a fight with one set of algorithms with another set of algorithms. Let's be happy in what it happens. Losses and profits would be there. They are only increased and enhanced by this inter-rocket rivalry and fighting. Thank you.